Okay, so I welcome you guys back to Denutsui tutorials, where complex topics are being made easier and much simpler for students to understand the concept and the basis. So without much time and waste, I'm diving into the practice questions for Business Finance 2025, which is likely to come in the exam. So they are examinable questions. They are the practice questions. Okay. So today I'm starting with I've done the objectives previously, so I'm starting with this particular question 1 here. The question 1 you see on the screen, this one. Now, with this question 1, it falls under the topic capital budgeting. So I have XYZ. So question 1, XYZ Manufacturing Limited is evaluating two mutually exclusive projects, A and B. Both projects require an initial investment of 150,000 Ghana cedis. The expected annual cash inflows are as follows. So I have project A, 40,000, 50,000, 60,000, 50,000 and 40,000. Project B, I have 60,000, 60,000, 50,000, 40,000 and 30,000. The firm's cost of capital is 10%. Required: A. Compute the payback period for each project. B. Compute discounted payback period. C. Calculate the net present value for both projects. D. Calculate IRR, internal rate of return. A. Give some advantages of using discounted cash flow methods. So since we have two projects in the question, we are supposed to, so it means if you are solving the A part of the question, this A part of the question, you do for project A and do for project B. If you are solving the B part of the question, you also do for project A and do for project B. Same applies to the C and the D. So with this particular question, one might ask, so this particular thing, which topic does it fall under? It falls under capital budgeting, what we call investment appraisal methods. Yes. Now with this particular question, we have tricks in it. This particular question, we have tricks in it. This one, the question stated that what? The expected annual cash inflows are as follows. So it means that I will just pick the numbers here or the cash flows here, then I'll just start solving. In a situation where the question has stated that the expected annual cash inflows are before tax. If it's before tax, I would first have to solve depreciation. Once I'm done with depreciation, I would add the depreciated amount to all the cash inflows here. So the new amount becomes the actual cash flows. And that is what I'm going to use in solving the question. But assuming the question has also stated it in a different way, that the expected annual cash inflows are after tax. If it's after tax, you just pick the cash flows here. Then you just do what? Start solving what? The question. Yes, that's the concept. So I'm writing it down, the things we are calculating for. Or let's analyze it here first, because I want to use the full screen. But this is the question I'm going to solve. This is the question. So I'm writing the information down. So we have, they said both projects require an initial investment of 150,000. So I have initial investment 150,000. Now take note, initial investment is the same as year 0. It means that year 0 has been given as what? 150,000. So now let me write down. So I have project A and project what? B. The firm's cost of capital is 10%. The firm's cost of capital is 10%. So let me write it. Cost of capital 10%. So you have project A and project B. So I want to go out of this particular screen, then we'll use the actual solving screen. So I'm writing down the question. So this is the question. You can take a pic of it, or you can write the question down before you move to the screen. So I've written the question now. So now let's go to the whiteboard. Let me copy the amount. So now we can use the whiteboard now. So let me start it here. So I have business finance practice question. Okay, so question 1. So with this question 1, it falls under capital budgeting. Under each question I'll solve, I'll show you the topic. This is capital budgeting, what we call investment appraisal method. Okay, so the project, I'm writing down the project. So we're given project in the question. We're given project A. So project A, we're given 40,000. It's in the previous screen. We're given 40,000. You're also given 50,000. You were given 60,000. You were given 50,000 again. You're also given 40,000. 40,000. Now we're also giving project B. With the project B, they gave us 60,000. They gave us another 60,000. They gave us 50,000. Take note, I'm picking the numbers here from the question I just opened. So I'm rewriting the values here, then I'll start solving. So so that I don't get confused. This is 50,000. This is 40,000. This is 30,000. So this is project B. And in the question, we were given cost of capital. So cost of capital in the question was given as 10%. Yeah, that's our cost of capital. So now, the A part of the question, which is the A part of the question, asks us to calculate for what? Payback period. Now, before you start, you always have to check out for the tricks. For me, I'll show you all the tricks involved. The first one is check if the amounts given to you are cash flows. For instance, if the cash flows are before tax, if it's before tax cash flows, if the cash flows are before tax, we solve depreciation first. If it's before, if the question stated that the cash flows are before tax, we solve depreciation and add it back to all the initial amount to get cash flows. This is the concept. Then also, if the question said that after tax cash flows, if it's after tax cash flows, it means depreciation has already been calculated. Depreciation has already been calculated. So we use the cash flows in the question. Now, also, if the question stated that expected annual profit, or operating profit, I'm showing all the tricks involved in capital budgeting. If the question also states that expected annual profit or operating profit, so expected annual profit or operating profit is the same as this. This one is the same as before tax. You first have to solve depreciation and add it back to all the initial amount to get cash flows. That's the concept. So we have, so one would ask, so how then do we calculate cash flow? So cash flow is, so you can do it the, how do I can call it the annual profit plus depreciation. So this is the formula for what? Cash flows. So since we now have all the tricks in mind, think we can I'm coming. I want to add more slides to there so that we can use a lot of pages for it. So I'm adding more slides. So actually 7 pages is okay. We can use that. Sorry about that. Let me. So now we have all the tricks in mind. We have before tax cash flows. We have after tax cash flows. So expected annual profit or operating profit is the same as before tax cash flows. So this is the cash flows formula. So remember the question, this is the question, project A and project B. So we'll move straight. So A is payback period. So with the payback period, it's talking about the time taken to recover an investment. That is the concept. Time taken to recover what? An investment. Time taken to recover an investment. So I'll do for project A and also do for project B. So project A, because we have two projects in questions. So I have my years column. I have years here. So we always start from year 0, year 1, year 2, year 3, year 4. We were given 5 years in the question. There's year 5. Then I have cash flows. So with this question, there was nothing like annual profit or before or cash flows before tax. It was just what? Cash flows. So we won't do any adjustments to the cash flows. We'll just pick the actual cash flows and start what? Solving the questions. So year 0, in the question, it was stated that initial investment. When you check the question, you say initial investment is what? 150,000. Let me write it here. The initial investment was given in the question as 150,000. So initial investment is the same as year 0. So our initial investment, I put it in bracket because it's initial investment, is 150,000. Year 1 was given us, I'm doing for project A, take note, 40,000. Year 2, 50,000. Year 3, 60,000. Year 4, 50,000. Year 5, 40,000. So after the cash flows column, the next column we create is what we call the cum cash flows. Cum cash flows, the cum here stands for cumulative. So basically what? Payback period. There's the tables we use. Years cash flows, cum cash flows. So with this cash flow here, you bring it to this side. Let me use the arrow. You bring it to this side. There's 150,000. So now you maintain this amount. You maintain this amount. This amount on the calculator. Subtract 40,000. I have 110,000. On the if point on the calculator, you get 110,000. Now maintain the 110,000 on the calculator, subtract 50,000. So we are getting 60,000. Now maintain the 60,000 on the calculator, subtract 60,000. That gives us 0. But in finance, we don't really consider 0. We write it as now. It's the same concept. But we would write it as what? Now, NIL. Now, since we are finding the payback period, the year in which we had the now, that is the same year I will or we will be able to pay back our what? We'll be able to complete our project, or we'll be able to pay back our loan, because it's saying that time taken to recover an investment. So you will check in which year did we get this now. So 0, 1, 2. So it was in year 3. It was in year 3 that we had the now. Therefore, the payback period is 3 years. So that's how we solve it. So I'm done with project A. So I'm going to solve. So B, no. The same A, but this one is project B. So project B to have years. So I have 0, 1, 2, 3, 4. I have 5. So these are years cash flows. I have cum cash flows. So the project B2 were given different amounts, but with the same initial investment, 150,000. Year 1 was 60,000. Year 2, 50,000. Year 3, 40,000. Year 4, sorry, there is a mistake here. Year 2 is, there was a mistake with the year 2's amount. So year 2 is still 60,000. Year 3, 50,000. It was given in the question. I'm picking them from the question. Year 4, 40,000. Year 5, 30,000. So now the cum cash flow, the same amount. You bring the 150,000 to this side. This is 150,000. Maintain it on the calculator. Subtract 60,000. We are having, let me punch into the calculator. We are having 90,000. So 90, you maintain this on the calculator. 90,000 minus 60,000. That is giving us 30,000. So maintain it on the calculator. Subtract 50,000. So what that's at 30,000 minus 50,000, you are running into the negatives. So once you notice you are running into the negatives, you would have to pause. So we'll check what was the last number here. This last number, the last number here was what? 30,000. I'll write it here. Divide it by the number that when I was about subtracting it from, it was getting into the negatives. It was this. When I was about subtracting 50,000 from this, it was getting into the negatives. So end here, this number, there's it, divided by the number that when you are about to subtract, it was given a negative, which was 50,000. So I have 50,000 here. Times 12 months. Why times 12 months? Just talking about time taken to recover an investment. So this is a rule. We always add it, 12 months. So we use a calculator. 30,000 divided by 50,000 times 12 months. We are getting 7.2, which is approximately 7 months. So therefore, the payback period for the projectors. Now, with payback period, the year in which we did the calculation, we don't pick that year. We pick the previous year. Why is it that way? You notice that in the year 3, I was getting months. So I don't pick the year 3. I'll pick the previous year. So the previous year is what? 2. So the payback period is 2 years. Then I'll pick this number of months I have it. 2 years, 7 months. So that's how we do it. We don't pick the same year. You pick the previous year. Then you pick the number of months. So that's all for the I part of the question. So I move to the I part of the question. So with the I part of the question, with the I part, we were asked to find the discounted payback period. That's the I discounted payback period. Now, with discounted payback period, it's the same concept as the payback period. The only difference is with discounted payback period, we use the present values. That is after we have calculated for discounted factor. But with cash flows, we use the actual cash flows in the question. But before you will be able to solve discounted payback period, you first have to solve for what? NPV, what we call the net present value. Because after you are done solving the net present value, we will be able to get the present values there to solve the what? Discounted payback period. So although II was asked, I would have to solve the III first, which is the NPV, before I will be able to solve my what? Discounted payback period. So I'll solve the III first. Otherwise, I won't be able to solve the II, which is the discounted period. So the III was NPV, net present value, which is the NPV. So with net present value too, it has its own format. So with the net present value, I'm going to do for project A, also do for project B. So this is project A. This is project A. So I'll do project A and also do project B. So with the NPV too, with project A, so this is, remember we're given a cost of capital of 10%. Cost of capital. 10%. Now, I have years. I have cash flows. I have discount factor. So I'll do is DF. So the DF here stands for discount factor. Then the last column is what we call the present value. So basically with the NPV, this is the table we need. So years, cash flows, discount factor, present values. Now with the discount factor, what is discount factor? The formula is 1 plus R exponent negative n. Either you use this or use 1 over 1 plus R n. Any of them is accepted. You can use any of them to solve the discount factor. So the R in the question, the N in the question, the R in the question stands for the cost of capital. The R is the cost of capital, which is the rate. And the N in the question stands for time or years, number of years. So with the years, so we project A, the same cash flow, we have 0, we have 1, we have 2, 3, 4, this is 5. So year 0 was given as 150,000. Year 1 was 40,000. I'm still using the cash flows for project A. So 40,000. Year 2, 50,000. Year 3, 60,000. Year 4, 50,000. Year 5, 40,000. So the discount factor. Remember, I said this is the formula we are using, that's or the second one. So we were given 10%. So the discount factor we know is 1 plus, so 10% is 0.1 exponent negative n. So if you want to find the discount factor for year 0, So this is how we do discount factor at year 0. It's 1 plus 0.1 negative n is time, so you put 0 here. This discount factor at year what? 0. If you want discount factor at year 1, it's 1 plus 0.1. Let's put the negative 1. So you keep changing the years here. You keep changing the years at the exponent side to get the discount factor. So let me do another one. Then the rest I'll use the calculator. So for discount factor for year 2 is 1 plus 0.1 exponent negative 2, like that. Then get all the discount factors. So the first one, 0, this is 1. If I punch into the calculator, so let me point this one to 0.909. After the points 3 digits, you pick 3 digits. If I point this one, so I'm getting 0.826. So the rest, I'll use a calculator. I was just showing you the format of getting what? The discount factor. So the first one, 1. The second one, I'm getting 0.909. The next one is 0.826. The third one is 0.751. The next one is 0.683. The next one is 0.621. So in getting the present value, this particular column, in getting the present value, it's the cash flows we have in the question times our discount factor. That will give you the present value column. This one times this would give us present value. So 150,000 times 1 is still 150,000. Remember, it's initial investment, so it's in bracket. 40,000 times 0.909. Let me punch it. That's giving me 36360. Now 50,000 times 0.826. I have 41300. Now 60,000 times 0.751. I have 45060. 50,000 times 0.683. I have 34150. Now 40,000 times 0.621. I have 24840. I have this. Now, I know most of you guys are wondering, so what if there's a scrap value introduced in the question? If there's a scrap value introduced in the question, NB, if there's a scrap value introduced in the question, we always add the scrap value to the last year's amount, this amount. You always add scrap value to this year's amount, the last year's amount. But since there was no scrap value, we won't add anything. So scrap value. In some questions, they might not give you scrap value. They will state it as residual value. Scrap value is the same as residual value. You might also not see residual value or scrap value. You see salvage value. It's the same thing. So we always add it to the last year's amount. Add to the last year's amount. That's the concept. So with scrap value, residual value, or salvage value, we add it to the last year's amount, like what I did here. You add it to this year's amount, but there was no scrap value, so I didn't add anything. So now in finding the NPV for project A. So NPV at project what? A. So the formula is our total cash outflows minus year 0. What we call the inflow, the cash inflow. So now, with the total cash outflows, you add from year 1 to the last year. You add all together. This is the total cash flows. You add from year 1 to the last year. So let's see. So the total is 181,710 minus year 0, which is the inflow, the cash inflow. So this was our year 0's amount, the initial investment, 150,000. So in subtracting from the calculator, I have so NPV at A, I have 31,710. So this is our NPV A at what? 10%. So this is NPV A at 10%. So NPV A at 10%. This is NPV A at 10%. Remember, so this is project A. So I move on to solve project B as well. So project B. So the same table format. You have years. You have cash flows. You have discount factor. The same table. I'm not changing anything. I have present value. So the years 0, 1, 2, 3, 4, 5. So remember, the year 0 was 250,000, the initial investment. So project B, the cash flow 1 was 60,000. Year 2 was also 60,000. Year 3 was 50,000. Year 4 was 40,000. Year 5 was 30,000. So with the discount factor, take note, since it's still 10%, we are using the same discount factors here. Remember, this is at 10%, like the previous one. So this one was 1. This is 0. So I'm just copying the discount factor from the top here. This is 0.826. This is 0.751. 0.683. This is 0.621. So now present value, I told you it's cash flow times discount factor, then we get this side. So 150,000 times 1 is 150,000. 60,000 times 0.909. I have 5 for 54,540. The next one, multiply cash flow and discount factor. The next one on the calculator is 49560. The next one is 37550. The next one is 27320. The next one is 18630. So that's what we have. So now the formula for NPV, the same thing. What we know, the same thing. The total cash minus year 0. So total cash outflows, you add from year to the last year, year 1 to year what? 5. So if we add everything on the calculator, I'm getting 187,600 minus the year 0, which is this. This is our year 0, 150,000. So 150,000. So NPV at project B In subtracting it, I'm having 37,600. So this is NPV at project B. So NPV. So NPV B at 10%. That's all. So that's how we solve the NPV. So now remember I made a statement earlier on that we have to solve present value first before we have to solve NPV before we will be able to solve the what? Discounted payback period. So now we can start our discounted payback period. So I'm renumbering it. So the discounted payback period was II. So discounted payback period. So with the discounted payback period, so I'll do for project A and do for project what? B. So discounted payback period. So this is project. So project A, I have years. I have the present value. Then I have cum present value. So I have this. So I was year 0, year 1, year 2, year 3, year 4, year 5. Okay. So now with project A, we don't use the actual cash flows in the question. No, for discounted payback, we use present value. So I'm coming to project A. So project A. So you notice that the actual cash flows in the question was this ones. But I stated clearly that with discounted payback period, we use the present values. So it means that if I'm finding for discounted payback period for project A, I will use the side. I will use the what? Present value side. I will use the side for the what? Discounted payback period. Why are we using present value for discounted payback period? I would also ask you my question. How did we get a present value? I multiplied discount factor. I multiplied discount factor by what? Cash what? Flows. And I was able to get the what? Present values. So it means that with the present values here, there is discount factor or there's a discount embedded into those figures because I multiplied cash flows and discount factor to get present values. So it means in the present value there's a discount, and that's the main reason why we use present values in finding for what? Discounted payback period. So in solving my discounted payback period for project A, I'll come and pick this cash flows, the present values cash flows here. So let me write it down. 150,000, 36,360, 41,300, 450,060. So 45060, 34,150, 24,940. Okay, I'm done writing it. So now let's go to the discounted payback period. So with the present value, the initial one was still 150,000. Year one was 36,306. Remember the present values, I'm picking them from the I part of the question. I'm picking them from this side because I'm doing for project A. I'm picking them from here. So 36360. This is 41300. The next one is 45060. The next one is 34150. The next one is 840. So the same format we use in solving the payback. The number here, move it here. So have 150,000. Maintain this on a calculator. Subtract 36,360. This one from that. That gives us 113640. Maintain it on the calculator. Subtract 41,300 from it. We have 72340. Maintain it on the calculator. Subtract 45060 from this. That would give us 27280. Now maintain this on the calculator. Subtract 34,150. So let me point it. So you will notice that 27,280 minus 34,150 is giving us a negative number. So the same concept. Once you realize you are running into the negatives, you would have to pause. Then the last number here was what? 27,280. So you write it here, 27,280. Divide it by the number that when you were about subtracting was giving a negative. And that number was what? This. It was this one that when we were about subtracting from this one, it was giving us a negative. So I'll divide by 34150 times my 12 months. So let me punch it on a calculator. So I have 9.58, which is approximately 10. So I have 10 months. So my discounted payback period. Now, you see, we pay back period, and as we pay back period, we pay back period, we pick what? We pay back period where you are getting the 0. Let me go to that side. We pay back period where we get the 0, that's the year we pick. Also in payback period, where we do the calculation, we did a calculation in year 3. Payback period, we don't pick that year. We pick the previous year. We pick 2 years, 7 months. Now, with discounted payback period, the year in which you did this calculation, discounted payback period, the year in which we did this calculation, that's the same year we picked. So I did this calculation, so I'll match it. I did this calculation in year 4. So I picked that same year in which I did the calculation. But with payback period, we don't pick the year in which we calculated for the month. We pick the previous year and the months. But with discounted payback period, we pick the same year in which we calculated the month. So the discounted payback period for project A is 4 years, 10 months. That's the discounted payback period. That's project A. So the trick, let me add it here. So trick. So discounted payback period. Same year, same what? Same month. That's the trick. So now, this project A. I'm going to project B. So project B for discounted payback period. So the same years. Present value. Cum present value. So I'll do it cum PV. So just shorten it. So I have year 0, year 1, year 2, year 3, year 4, year 5. So with the discounted payback period for project B, I'll go and pick the present values for project B. So this is the present value for project B, this one. So I'll pick this one down there. Let me write it. Okay, so let me go straight to that place. Okay, so the present value, the initial one was still 150,000. So year one was 5454. Remember, I'm using the present values of project B. So this is 49560. This is 37550. This is 27320. This is 18630. So the same concept, you bring this one to the side. That's 150,000. Maintain it on a calculator. Subtract 54,540 from 150,000. We are getting 95460. Maintain this on a calculator. Subtract this number from this. That gives us 45900. So maintain on a calculator. Subtract 37,550. We are having 8350. Now maintain this on a calculator. Minus 27,320. You notice that you're running into the negative. So we would have to pause there. So the last number here, I write it down. 8350. Divide it by the number that when I was about subtracting, it was giving us a negative. That was this number. You will notice I was about subtracting this from that, and I notice I'm getting negative. So I'll have to pause. Write this number down. Divide it by this number. 27320 times 12 months. So our answer is, let me punch in the calculator. We have 3.67, which is approximately 4 months. So the discounted payback period. Remember, I told you that with discounted payback period, we pick the same year, same month. So I did this calculation in year 4. Look at this. I did a calculation in year 4. I did a calculation in year 4. So I picked the 4th year. So 4 years, 4 months. So that's all for the discounted payback period. So the next one was asking us to solve for. Let's check it. So I've done the A, I've done the B, I've done the C. So we move on to the D. The D part of the question is telling us to calculate internal rate of return. Was it D? Okay, it was D. So I think let me number it in that way so that you don't get confused. I think that would be the best. So this is A. This one was C. Let me renumber it for you. So this is C. I'm renumbering it, and don't worry. I don't want you to get confused. So this was B. Okay, that's it. So we are moving to the D. So the D was internal rate of return. So with the internal rate of return, it's talking about alternative rate. Alternative rate apart from the actual rate. the alternative rate apart from what? Apart from the actual rate. The alternative rate apart from the actual rate. So now, in the question, let me go to the question. So you notice that in the question, this the only stated calculate IRR. They didn't give us any rate. You see the previous one, they gave us 10%. But with this one, they didn't give us any what rate. Now, when you are calculating for internal rate of return and no rate is given, we assume 20%. So we assume 20% cost of capital. So one would ask, why 20%, not 15, 16? You can use any of them. Just that with those ones, you will find it difficult in dealing with the approximations. Is it okay? So to avoid this approximation issues, to get fixed numbers, that's why we use what 20%. So we assume 20% if the internal rate of return is not given in question. So now with this internal rate of return I have here, it has a formula. It's L plus I have NPVL over NPVL minus NPVH times H minus L, where the L is lower rate, H is higher rate. So NPVL means, you know, L is what? Lower rate. So NPVL means NPV at a lower rate. NPV at a lower rate. So NPVH means NPV at a higher rate. That's the concept. So now I'll do for project B. Sorry, project A first. Okay. So you notice that with the IRR formula we have NPV in it. So I've done the previous one, which is 10%. So 10% and 20%, which one is lower? It's 10%. So it means I've done for it means I know L 10%. I've done for NPVL. I've done for NPVL. I know of L2 lower rate. So I'm left with what? NPVH, which is what? So it means NPV at what? A higher rate. And the higher rate now is what? 20%. So it means if I'm solving the NPVH, I'll use what? 20%. So it means I'm going to solve for NPV for project A using 20%. Solve another NPV for project B using what? 20%. Before we would be able to use this formula. So I'm starting. So here, yes, I have yes. I have cash flows here. I have DF, discount factor. Then I have present value. So remember, now the R is what? 20%. So the discount factor is 1 plus 0.2 negative n. You keep changing this one based on the year you are finding, but this is years. So if 1 year 0, you put 0. If 1 year 1, you put 1, like the way I did the previous one. So this is years. This is cash flows. Discount factor. This is present value. So I have 0, 1. This is 2. This is 3. This is 4. This is 5. So the same cash flows. The only thing is we are just changing the discount factor to this. So the same cash flows, 150,000. 40,000. 50,000, 60,000, 50,000, 40,000. So the discount factor, we are using this. So let's say the first one, discount factor at year 0, it's 1 plus 0.2 minus 0. If you want discount factor at year 1, it means 1 plus 0.2 minus 1. If you want discount factor at year 2, it means 1 plus 0.2 minus 2. You keep on changing the discount factors. So the first one will give us, punching this on the calculator is 1. This one will give us 0.833. This one will give us 0.694. So you continue in that format. So I'm just coming to put them here. So the first one is 1. The second one is 0.833. The next one is 0.694. This is 0.579. This one is 0.482. This one is 0.402. So present value. As I told you, that present value is what? It's cash flow times discount factor. 150,000 times 1 would give us 150,000. So 40,000 times 0.833 would give us 33320. The same formula, 50,000 times this. So I'm just writing the totals there. So I'm done with the table. So now NPV, this NPV at A. So our total cash outflows minus the year 0, which is our initial investment. So now I told you that with the total cash outflows, you add from the side to the last year amount this side. So let's add it. So I'm getting 1,42940 minus year 0, which is this. This is year 0. Year 0 is 150,000, the initial investment. So NPV at A is minus 7060. So this is NPV A at 20%. So I'm coming to do for project B2. So I have years, cash flow, discount factor, then I have present value. So I have year 0, year 1, year 2, year 3, year 4, and year 5. So year 0, it was the same what? Initial investment, 150,000. So year 1, it was 60,000. Year 2 was also 60,000. Year 3 was 50,000. Year 4, 40,000. Year 5, 30,000. Discount factor, remember, is the same thing we are using. Like, what are they for the project E? So the same discount factor here. Sorry, the first one is 1. The next one was 0.833. This one was 0.694. Okay, so I'm done with the discount factor column. So multiply cash flow by discount factor. Then we get what? Present value. So the first one, the same format, 150,000. So 60,000 times 0.833. We have 49980. The same format. The cash flow times discount factor, then get the present value. So let me just point on the calculator and write the answers. Okay, so I'm done with the table. So now NPV at B. So I have the total cash outflows minus year 0, which is initial investment. Okay. So with it, as I explained earlier, on the total cash outflows, we add from year 1 to the last year. So I'm having 151910 minus year 0, which is 150,000. So NPV at project B would give us 1910. So this NPV B at 20%. So we now have to calculate for what? The internal rate of return, since we have all the projects now. So I'll do it like this. So project A internal rate of return, so that we don't get confused. So project A internal rate of return. So I have IRR here. This is L plus NPVL over NPVL minus NPVH. This is H minus L. So since we are dealing with project internal rate of return for project A, we'll come and pick all the information for only project A. So with The L, we know L is lower rate. So lower rate was 10%. H is higher rate, which was 20%. So remember, we are picking everything project A. So this is NPVL. So it means NPV for project A at 10%. So it will come. So let's go to 10% project A. So this is project A at 10%. Let me write the number down. 31710. Let me write it down. So now let's go to NPV at project A, but at what? 20%. You look for NPV for project A at 10%. Look for NPV for project A, but what? At a higher rate, which is what? 20%. So let's check. So this is here we use 20%. Remember. So NPV for project A 20%. NPV A at 20% is this. So let me write it down. Okay. So we can start. So NPVL at a lower rate 10% for project A. The answer was 31710. Then NPV for project A but at a higher rate was -7060. You can cross check it, you see it in the solution. They are all in the solution. So lower rate 0.1 plus NPVL is 31710 divided by 31710 minus NPVH minus 7060. Each is 0.2 minus 0.1. That's it. So now, internal rate of return. So this is 0.1 plus, I have 31710. This is 31710 plus 7 again is for 7060. This is 0.2 minus 0.1. So the internal rate of return. So you punch this on the calculator. We are getting 0.182, or since it's rate, you can send into percent, or 18.2%. So this is NPV for project IRR for project A. So now I'll go to project B. So project B. So project B, internal rate of return. So the same format. This is L. This is NPVL over NPVL minus NPVH. H minus L. So remember, the L is still 10%. Lower rate. H is still 20%. Higher rate. So now we need NPVL. So remember, this is project B. So we'll pick everything project B. So it means NPV at 10% for project B. Let's come to this side. So NPV at project B, 10%. NPV project B, 10%. So this is the amount. Project B, this is it. So now I've written it. So let's go to NPV H, 20% for project B. There's a 20% for project B. So we'll come and put it there. My laptop is going off, so let me put it on chat. So the MPVL lower rate for project B, it was 37600. Then MPV at a higher rate for project B, we had 1910. I picked them from the solution, so I just substitute here. This is 0.1 plus I have 37600 MPVL over MPVL 37600 minus 1910 minus 1910. So higher rate, this is 0.2 minus 0.1. So internal rate of return for project B, we will point this on the calculator. So I have 0.20205, which is 20.5%. So this is how we solve the internal rate of return. So let's check the last part of the question. The last part is advantages of using discounted cash flow methods. So this is a theory. This is a theory though. It's not a calculation. Advantages of using discounted cash flows. I think you guys can read on this. It's basically the theory part. But I think I can give you two. The first one is one advantage of using discounted cash flow is based on the concept of time value of money. The second one I would also make mention of is intrinsic valuation. We need it. It's an advantage of discounted cash flow. So you can try and read more on the theories as we solve the calculation here. So that's all for the question 1 of your tutorial questions.